Welcome to the Catalyst Funding Real Estate Market Update. It's October 27th at noon, and as promised, we have the real estate market update coming live, and a number of people I've heard have joined us today, but also a number of people have gone ahead and done the great thing of registering just so that you can get this great content sent right to your inbox afterwards. And so we'll hope you stay with us today for the whole thing. But I know a number of people as well have decided that a great thing to do is have this emailed right to their inbox. So without any further ado, I want to introduce today both the founder and CEO of Catalyst Funding, Comeaux, as well as our director of lending, Jeff Johnson, and they're going to introduce our guest speaker for the day.
Yes, so I'm going to introduce Haitham and then have him talk a little bit. I really like working with the Benchmark team. They represent me on my insurance for my rental portfolio as well, and have always done a great job. They have some very innovative products, but they're really built with the investor in mind. I think that's the biggest difference. We sometimes see borrowers come to us that try to use the person who provides their primary residence insurance or their life insurance or something like that, and those people really struggle to understand the real estate investment game. But Haitham and his team are excellent in the space. They have innovative products, and they can really walk you through that process. So Haitham, tell us a little bit about your company and also maybe some new things going on in the space.
Thank you for having me on, Wade. I really appreciate it. Love to join you guys. And, as you know, Benchmark, we've been around for over 15 years. Definitely more of a boutique style agency. Starting out, we were generalists. We wanted anything and everything. But somehow, some way, we kind of worked our way in as a boutique agency for investors. We really can touch up on the pain points for clients because we're investors ourselves. So we really know the type of coverage that you would want or need in an investment. And some of the concerns when shopping for insurance. I think that really helps relate to the investor as to all facets of the investment, of what they need, how to really optimize and save money on their insurance, making sure that you're not sacrificing coverages or deductibles. And that really helps. I mean, new products, obviously we have our REO program package, which allows you to consolidate all of your properties onto one policy, which is very similar to your policy that you have. It covers the property while vacant, under construction, or occupied. So in the past, you would purchase, a builder's risk policy, and then you're looking for a tenant, so you have a vacant policy, and then you convert that and switch to a dwelling fire. Well, in that process, you're losing hundreds or thousands of dollars while you're canceling and restarting policies. In this case, let's take everything into one, consolidate it, and really just build a foundation for yourself. It's all about showing profitability to the insurance company. And by you having a full list and a loss run schedule, you can show, hey, I have 10 million in property. I've had no claims over the last 5 years. And you're able to negotiate that down. So, just a little bit about us and happy to be here today.
Yeah, I'll also say the most important time to have great insurance companies whenever you have claims. And I want to give some kudos to Benchmark. Whenever we had claims back in Harvey, they were incredibly efficient. I mean, really driving the process, ensuring that we were able to get the money in order to make the repairs. And we were able, because of that, able to get way ahead of the game. A lot of our competitors get our tenants back into the properties, both for their sake, most importantly, so they could have a place to live, but also to help us with our revenue. And it was really impressive because I know they had an enormous amount of claims to deal with, and they were just constantly available, working around the clock whenever you really needed them. So that was one of the reasons that I've been with you guys as long as I have. It was really helpful for sure.
I really appreciate that, and that really is attributed to our claims consulting team. So not only are we investors, but we have construction background. So being able to speak the language in terms of claims and what replacement value is, and how to really tackle an adjuster when you're filing these claims is really going to set you apart, and not just wait for them to give you what they decide to give you, but being more proactive and saying, this is what you owe me to remodel my house. And having that construction background certainly helps. Knowing these adjusters, having a good program to fall back on, making sure that your policy's on A paper, you know, a lot of that stuff goes a long way. And I appreciate to hear that. I mean, I know with claims, it's such a crapshoot nowadays. Some people have great claim service, some people don't. But at the end of the day, you know, you don't know what you have until you need it.
Yep, 100%.
So walk me through that just real quick. I know you said that for like a lot of our folks they buy and hold investors, so they have to get multiple policies throughout the process, correct?
Correct.
And you guys have something that's a little different. Is that correct as well?
That's correct. So the minimum requirement is 5 properties, right? So basically we're taking a schedule, you know, an Excel spreadsheet. We'll list all the properties. We'll list the year built and the updates to the property, and we'll go to the program and say, I want to take all of these properties and consolidate essentially. And you just have a lot more leverage with that. You're also getting $2 million in general liability for lawsuit purposes, any third-party injuries or lawsuits. You're getting wind and hail in coastal territory. So if you have properties in Galveston or near the coast, we're not having to go to TWIA or to these other programs that have very limited coverage. So you know, it just gives you much more flexibility. And this package runs nationwide. I have policies in Michigan and Indiana and Georgia. There's no limitations to where you can actually have coverage on this, and it's all based on zip code. So wherever your zip code lies is what the property rate will be. But most importantly, it allows you to dictate the coverages, right? So if you're going on individual policies, nowadays with cost of inflation, the rising cost of construction costs, they're wanting or forcing you to insure a property for $150 to $170 a foot, right? Well, if I bought this house for 80 grand, I put 20 grand into it, it's 2,000 square feet. You know, I only want to insure it for 140, 150,000. This policy allows you to tweak the coverages a bit, still giving you replacement costs, so you're not paying for coverage that you don't need. Obviously, if there's a fire, and you know, you will need every bit of $100 to $120 a foot. But you know, in my years of doing this, I've probably seen maybe 6 or 7 total losses in 15 years.
So I'm assuming by combining them like that into one versus individual policies, on a per property basis, it's significantly cheaper. Is that fair?
Absolutely. So you go through different tiers, right? So after $1 million in total coverage. So if you have 5 properties at 200,000, once you get to $1 million, I can basically negotiate your property rate down by 5 cents. And what I mean is, you basically divide your premium to the total insured value, and that's your property rate. So in Harris County, we're running as low as 65 cents, which is $650 for 100,000 in coverage.
Yeah,
that's almost unheard of. And obviously, the more coverage that we have, the less that your property rate will be. And obviously, if you have no claims, we can negotiate that down as well.
Yeah. So the reason why I brought that up is obviously, if it's a good service, it's going to save people money. But we're doing it with rates going up. Conventional rates are very close to non-conventional rates. We're doing a lot more DSCR loans. So DSCR loans are debt service coverage ratio. So the cheaper your insurance is, the more property you can buy. Some of the deals we get, you may collect a lot of rent, but say for whatever reason the other, maybe it appraises for a little bit less, and that debt service coverage ratio is really tight. If you have insurance that's a lot more affordable, it will allow you to qualify, because you have to get over that threshold of having a profitable property. And sometimes, the difference is not much at all. And so the savings on insurance can go from somebody not buying a house to buying a house. So it's definitely important to be looking at those things.
Less out of pocket, right? Can really change out of pocket, the amount of cash out you get. Like that DSCR, sometimes with the same property, you'll just have to drive down the loan amount, which has a lot of unfortunate circumstances if you can't get that insurance dialed in. So it's always good to check the benchmark to see where you're at.
Absolutely. And that's happening a lot on the multifamily side as well. It's all about your cap rate and how much you actually make. And if your insurance is doubling or tripling for that matter, it makes it that much tougher. So we had to find innovative ways to contact insurance companies and say, hey, this is kind of the model of our business. This is who we target. give us a policy. And this doesn't just translate to your fix and flippers. It translates over to lenders that like to force place insurance. Not saying that about yourself, but also to yeah.
Our people pay. Our people always pay. What are you talking about?
Oh, absolutely. Subject to guys, guys that are doing wrap loans, people who are doing Airbnb. I mean, it just gives you much more flexibility. You don't have to actually go out and individualize every single policy and pay top dollar for it.
Absolutely. I think that's a real good breakdown. We'll have time at the end for questions. So if you guys have any specific questions for Haitham and the products they provide, definitely put those into the questionnaire section on the webinar here, and we'll definitely cover those a little bit later on. Most of you guys know who Jeff and I are, so we will just dive into this value proposition of what we offer as a company. We are a one-stop shop for both hard money and permanent financing. We love to work with flippers. We do a lot of transactions in that category. Then we also really specialize in a category of having a one-stop shop and a very integrated process for people who want to do fixed to rent. We have the ability to provide a wide variety of long-term products, and really, rather than trying to force you into a product that's not best for you, put you into the products, one of the many products we have that are going to be best for you as an individual. And we are built by real estate investors. As I mentioned earlier, we have a pretty large portfolio ourselves that Haitham and his team provide the insurance for. We've been involved in thousands of transactions over the years. You have one single point of contact from a loan officer perspective that guides you through the entire process. We average 5-star reviews on all social media platforms like Facebook and Google. And we have non-qualified mortgages with FICO scores as low as 620. And then we also have some pretty innovative short-term rental loans for, that's a really hot category right now. And if, sometimes people struggle to get the debt service coverage ratio in line on those larger homes that are for Airbnb or VRBO, short-term rentals, like Jeff was talking about earlier. But we do have a very innovative product that does not have a DSCR requirement that allows you to get into those properties that a lot of times with a lot of our competitors, you may not have an option to buy a $1 million property down in Galveston or in the Hill Country or somewhere else across the country, Colorado, because that DSCR number may be problematic.
Yeah. The only thing I'll say on this page, I think we lost Haitham. I highly recommend if you're there. He is.
Oh yeah.
He made that intro into what his company does. He just dropped the mic and then everything.
I was like, this guy just shows up for his piece and he's like, I don't care what these guys have to say. I'm out. I'll come back around a little bit.
I thought you were asking me to go, but no, we're good.
Oh, that's great. No. I was going to say is if you've been paying attention over the last year or two, everyone's built up a ton of equity, and now is the time to try to pull out as much cash as you can, because I think, with things getting a little tougher in the economy, I think there's going to be some real opportunities to jump in with both feet and buy a lot of houses over the next year or two. So, and I don't think rates are going to go down anytime soon. So if you've been holding out on trying to pull some cash, if you need it to buy properties, I highly recommend talking to somebody about doing a cash out to be ready to go, because I think the opportunities, I'm just anecdotally talking to folks that buying houses. I think the opportunities are starting to grow a little bit and they become more economical. So by all means, I recommend talking to a loan officer about how much cash you'd be able to pull out if you need it to start buying some houses.
Absolutely. And I'll say one other thing before we dive into the presentation to echo Jeff's point. Home prices, we're going to go through this. They're not dropping significantly. There's some areas of softness across the country, don't get me wrong. But home prices don't have to drop for investors to have better investment opportunities, right? All that has to happen is that investors on average are paying less of a percentage of the after repairs value than they were before. And that is definitely happening because cash flow drives that number. And if rates are higher, it's hard to get the cash flow. So prices are coming down. Distressed sellers are getting less. Wholesalers are making lower wholesale fees, and the market's just starting to normalize. We were really overpaying when rates were super low. But here's the thing to think about. if you already have the lowest possible rate and you overpaid for the home, you have less equity, right? And you don't have you don't have the ability to lower the rate to make even more cash flow. In the current environment, you get a better price. And while you're paying a higher rate, whenever rates do inevitably come down, you're going to be able to crush the cash flow by refinancing into a much better mortgage payment. So it's a very exciting time. The more savvy investors I'm talking with out in the market right now are being very aggressive because of that key concept that you can get a better price on the home, a lower percentage of the ARV, but have that much lower interest rate at some point in the future. So it's really exciting times.
Yeah, when I said anecdotally talking to people, what I was referring to is exactly that, like just less out of pocket buying the deals, and the out of pocket is a derivative of how well they're being bought. You know, you're not seeing the deals in the high 80s and low 90s as much. It's more they're coming down into the 70s and low 80s. I don't know, Haitham, if you see that, if you're in tune to that kind of stuff or not, but that's what we're seeing at least.
And how long do you presume that the rates are going to be as high as they are? I mean, I think prime is at 5 right now.
6.5.
6.25. So how long? I mean, when do we start seeing that trend go down? And I know that's probably a good guess, but
one of the slides at the very end of the presentation.
We're going to go over that in a good second.
Yeah,
that's a great topic to dig into. Yeah. Well, so let's go over that whenever we cover the slide. I think right now, if we could go over the next slide, that would be great. Can we pull that up, team? We seeing that right now?
It's blank to me. I don't know, David or Derek, I don't know if you guys have the, there it is. All right, we're back.
All right, perfect.
More.
Now we're cooking.
More. Back.
I think page 6. Perfect. All right, Jeff, you want to run with?
I got the wrong one up. My bad. Go right ahead. Yeah, sure. So this is an article we found in Bankrate. I'll just read through the notes and then you guys feel free to jump in. So housing prices, forceful deceleration. I think we've been talking about this for a while now, is that you're not necessarily going to see a crash, but you're going to see a deceleration in the acceleration. So although U.S. housing prices remain substantially above their year-ago levels, July's report reflects a forceful deceleration. Prices fell in 15 of the top 20 cities from June to July. So when you're comparing the June prices to the July prices, they were down in 15 out of the 20 top markets. While prices are still growing compared with a year ago, that is the largest 1-month decline in the history of the index. So things are slowing down for sure. Like I said, we don't have any of the reports, at least in the markets we checked. I didn't see anything where the prices are down year over year, but it is month over month. So those stupid acceleration numbers that we saw over the last couple of years are starting to peel back for sure.
Yeah, it's a more normalized market. I mean, think about it. Right now we're in September, October. In every other market we were in before the COVID-driven market was really a lot of seasonality. Home prices were really up in the summer when everyone was buying houses. If you're trying to sell a house in the outside of those peak times, there was always some degradation, both in the speed at which homes sold and also the values that they had. So I think we're probably going to see that going through this winter. Last year was highly unusual. You know, the market plowed right through the winter without any issues just because of a lot of circumstances of scarcity of homes and people not buying for a while. But we're definitely going to see a normalized market. And then secondarily, home prices are going to be impacted by interest rates. There's no doubt about that, right? But that does not mean that investors are not going to be able to really get some exciting opportunities because of this. That's a good thing.
And I've seen a lot of activity over the last month as well. I mean, nothing has really slowed down. You know, just in the last month, new home buyers, I mean, we're still where we were last year in terms of closing policies and activity. Things have not slowed down on our end either.
Very good.
Next slide.
Yeah, so this is an interesting slide. U.S. rents are now declining. That's the headline of the article on Bloomberg. It's not a significant reduction, and I think this made a lot of the news out there. So we thought it was very important to cover, right? So rents nationally increased 7.5% year over year. So rents are still up year over year. There was a slight reduction last month. And if you look at the chart displayed in that article, it's really a lot of the seasonality that we've seen in the past. I mean, just like home sales are a lot more robust in the summer when families are more willing to move, change school districts, et cetera. They don't really want to do that in the middle of the school year. So we're seeing a lot of that seasonality. Earlier this year, rents were up 18%. Now they're up 7.5%. So there is a reduction month over month. But in most of the previous cycles, 2019, 2020, 2021, that seasonality is somewhat common. Although, as we kind of mentioned, there wasn't really as much seasonality last year just because the market was so hot in every way and there was such a scarcity. But we were definitely getting to a more normalized market where seasonality, I think, is going to be a big part of things going forward. And in the past, we always broke records in December. One reason I think a lot of investors want to get those tax advantages for the year, but another reason is it's just a really good time to buy homes if you're an investor because there's so much less competition from the retail buyer.
Yeah, what that chart tells me are two things. One, like I said earlier, even if you consider rates high, and they are relatively speaking to recent history, they can always go down and you can refinance, right? And then second, though, even if they aren't going down so much, historically, you lock in that payment. You may have a little bit of increase in insurance or taxes over the years, but historically, rents are going to way outpace increases in taxes and insurance. So even if you feel like you're getting squeezed and you're not getting a ton of cash flow right off the bat, just hold on to the property, and eventually those rents are going to significantly increase over time, for sure. Right, so it makes sense to get into these properties, even if you have a lower cash flow up front, because eventually that's going to catch up, and you're gonna either refinance, which will be an instant jolt, or just over time as you renew, leases are going to go up.
And this is national, right? We're going to cover some Texas-based information in a bit. A lot of our investors are in Texas, so we'll cover that a little bit later on.
So this is a question, I see a lot of articles on this, I'll just go through it and then, like I said, you guys feel free. Is the U.S. housing market in a bubble? So Zillow did a study that had 100 experts from government, academia, and the private sector, asked them about the status of the housing market and future growth, inflation, and recession risks. It says 60% of those polled do not believe the U.S. housing market is now in a bubble, compared to 32% who say it is, and 8% who are unsure. So if you look to the right, the reasons why people believe it is not a bubble kind of breaks down the main reasons. So recent price growth can be explained by fundamentals such as demographics, housing preferences, and scarce inventory. Credit risks remain low due to sound underwriting and mostly fixed rate mortgages. The term bubble implies a subsequent crash, and there's not a likely one to be soon. And then lastly, in real terms, home price growth is high, but not excessive. So we've been talking about a lot of the fundamentals, at least those top two reasons, in my opinion. Price growth can be explained by fundamentals such as demographics. We've been talking for years now about how millennials are the biggest population group we've ever had, and they are in prime home buying age, right? So there's almost like a floor of buyers. Things are going to get, if the rates go up, I understand that drives some people out, but that population group is so deep. There's a floor of buyers that are always going to support the market to a certain degree, in my opinion. And then the credit risk, we've been talking about that for a while. One of the biggest, if not the biggest impact on the previous housing bubble of 08, 09 was that there were so many people getting mortgages that just did not need to get those mortgages. They're being propped up by just aggressive lenders and Fannie Freddie just trying to support that market, and that's just not the way it is right now. There's nobody getting these stated income asset deals, 500 credit scores on interest only payments where it's just not happening. The credit quality is still really, really sound. So I would be surprised if we see anything like we saw back in 08, 09. I don't know if you guys have a different take on that, but.
One thing I will say to your point, these alternative products, there are an enormous amount of products that would actually have negative amortization, right? Where the payments were so low that you would not pay down principal, your principal would increase, which kind of sounds crazy, but home prices were going up so consistently that lenders were willing to come up with these innovative products. And you can only imagine from a homeowner's perspective, that puts you at a pretty tough spot. If home prices are going down and your principal's been going up, that's a very scary thing. And then there were tons of ARM products. The number of ARM products, I think there are 8 times as many ARM products as there are today. ARM products are a very low percentage of the overall housing market. The factors are entirely different. And I do want to mention this last one, that whenever inflation is 8.2, 8.5%, and home price appreciation is 15%, that's a delta of 7%, which is really in line with the historic appreciation numbers. That's not an outrageous number. So that's another thing to keep in mind. What's happened the last few years with home price appreciation was driven by the inflation numbers. So I think that last one, while it did not get a ton of the voters' votes, it only got 7.8% of the votes, but I do think it is another factor to consider. Maybe not as important as some of the others that Jeff really emphasized, numbers 1 and 2, which definitely got the majority of the vote. But I think that's another thing to keep in mind. So I think the next slide would be great. So this is the topic that Haitham brought up earlier, which is a topic that comes up everywhere right now. What is the trend for interest rates? So rates topped 6% for the first time since 2008. I did see the other day, as of October 26, 7.12. I saw the other day, I think it's the highest interest rates, I want to say like in nearly 30 years or something like that. So the interest rates are higher than they've been in a while. But I mean, one thing to keep in mind is that historically, that 7% rate is the lower than the historical average long term, right? So there's a chart that we often show that really shows the long-term trends over time. But I'm of the opinion that we're going to probably have at least 3 more raises before January. There are 3 Fed meetings. There's a November Fed meeting, a December Fed meeting, and a January Fed meeting. They've already articulated 3/4 point increases for, I think, the next 2. That's the direction. They haven't stated that with certainty, but that is the direction. And maybe another 0.5 point. So you can see rates potentially raise another 2%. That is not unrealistic to think about. The great news about it is I think that's going to continue to push home prices down maybe slightly, but the prices at which investors are buying properties down even more. And if you have the confidence to get into a deal that still cash flows, get at a great price now, the upside for cash flow, if you're at an 8 or 9%, and whenever you go to refi someday in the future at rates where we were in the recent past, is just really exciting.
It's time to capitalize on deals now then.
Yep.
Yeah, so this is the chart that I think Wade was referring to. It shows the historical rates starting around, I guess, 1970, and then carrying all the way through. So, I mean, you can see this is the Fed funds rate, but you can see where starting in like 2010 to 2015, it was effectively 0. There was a little spike, and then right around 2020, they kept them at 0 for almost, I guess, 2 years until this recent spike. But like Haitham just said, relatively speaking, historically, I mean, there's a lot more time above this line than there is below this line. If you, I mean, and it's significant too. Like, it's not just a little bit above. I mean, some of the time periods in the 90s and the 80s clearly were massively above the line. So while it's a shock because everyone's used to what's been going on the last 5-10 years, if you look back a little bit, it is not that big of a shock. And free money is not normally out there for as long as it was.
Are we ready for the next slide?
Yeah, this is it.
Okay, my bad. I'm sorry. My screen was jacked up for a second there. So 3 scenarios for interest rates in 2023. 1, inflation continues to remain high, and the Fed is primarily using this lever. The administration as a whole is primarily using this lever to impact interest rates. So they're going to keep raising them until inflation starts to slow down. So I think that's a very probable scenario in my opinion. The next one is that the consumer price index responds more to the Fed's rate increases. And then there's a gradual deceleration of inflation, which could maybe cause rates to stabilize at the numbers they're at currently for 2023. I think that's a real possibility because, you know, you have two opposing forces, inflation and recession, right? And we could technically be in a recession. That, you know, that's debatable, I guess. But at the end of the day, if the economy slows, there's going to be real incentives to take down rates. So that's going to be two things that are moving in opposition to each other. And I think that you're definitely starting to see that recession narrative be pretty strong. So I think this scenario 2 is very reasonable as well. Maybe an uptick for a moment, come back down even, maybe some rate reductions over time. Then Fred, the scenario 3 is that the Fed continues to raise rates to curb inflation, then the economy falls into recession, which could cause rates to likely drop to 5. Now, I think that is a very probable scenario. The question is, when does it happen? This is saying 2023. I think it inevitably happens, and below 5, in my opinion, probably by a large margin, because these things tend to overcorrect, right? It's a pendulum. You're working really hard to get it going in the other direction, and you can't turn an economy on a dime. It's an old tanker. It's not a speedboat. So we're going to see this trend. The question is it 2023 or 2024? And in my opinion, rates get significantly below 5% eventually to spur the economy whenever we probably have a little bit more of a hard landing than a lot of people are hoping for. You guys have anything to add to that?
No, I mean, I could see all three possibilities. Like you said, it's just these competing factors between the economy and inflation. And I do think as scenario number 3, that's like that would be the golden scenario for investors. If a recession hits, you're going to have more distressed property opportunities. Like it's sad, but it's a reality. So those are that's why I was saying earlier, get your cash position ready to go so you can buy some properties, because if that happens, that's when you can really make some progress on your financial wealth. You're going to be buying properties. A lot of distressed opportunities means there's fewer buyers and more sellers. So those prices are going to come down. Your cash out of pocket should be lower. And then if rates are even cheaper, that's all the better, because that's like scenario 3 is obviously the best case scenario for investors. They're all good scenarios to invest in. But if 3 hits, I mean, look out. That's when you can really make a lot of money. So this is I think it was a quote we found. So by the end of 2023, financial market participants expect that the Fed will have increased the target fund rate by 175 to 200 basis points from current levels. That would translate into 30-year and 15-year rates at 8.5 and 7.7. This is from Robert Johnson, a professor of finance at Creighton University. So this is just, I guess this is this one gentleman's theory, is that it could go up another 175, 200 basis points. So yeah, you're talking 8.5 to 7.5, 7.75 on these rates.
And you know, it's not to break this down a little bit. The Fed funds rate is not a direct correlation to mortgage rates, right? There's no hardline correlation there. But with the amount of increase that we have seen since the beginning of the year on the Fed funds rate, and even the prime rate, and then the mortgage rates, they've all kind of moved very similarly thus far. Now, oftentimes mortgage rates will move in anticipation of a Fed move. Sometimes it's already baked in, but I'm talking over the long haul. It's been pretty relatively highly correlated, and we think that will probably continue going later into the year. So the question is, to Jeff's point, if I want to be an investor in this space, is it best to go ahead and get cash out now while rates are a little bit lower if we anticipate them increasing? Not as low as they were a year ago, but you can't change the past. If you have a couple $100,000 in dry powder in your property, in your primary residence, or in your rental portfolio, maybe even more than that, to put to work, you know, an increase in interest rate on your primary mortgage or some of your rentals is just a cost of doing business in order to grow things much more significantly. And there are always costs of doing business. So I think that's a great point Jeff's making about potentially taking some cash out from wherever you might have it. So Haitham, I know you guys have a lot of deals, a lot of people's properties in your portfolio that may have 10, 20 properties, and then you'll get the request, hey, from the lender, we're increasing these loan amounts, and you're going to have to increase the insurance a little bit. But I mean, are you still seeing some people taking cash out from their properties and getting those requests to increase?
More so than ever. We get more requests for increasing coverage. Obviously, lenders have different requirements on what they want, loss of rents and all that. But more so than ever, we've gotten more endorsements for investors that are doing cash out refis, just trying to capitalize on opportunities, get more money to buy deals. This is the new normal, right? I mean, obviously, being stuck in the past and saying, I want my rate to be 3% is just long gone. So, a lot of my clients have buckled down and said, let's get as much money as we can to capitalize on these distressed properties and make some money. I think, trying to hold on to your money at this time doesn't do you any good. I mean, interest rates still suck in terms of leaving it at the bank. So, most of my clients, most of my investor clients that have portfolios of 20 or more are doing more deals and doing cash out refis.
Yeah, it's funny. I think people who've had a portfolio for a while, they see the benefits in higher rate environments, lower rate environments. Like, there's so many benefits to owning more properties that they just see that interest rate is like a small factor in the overall decision. People who are a little bit newer may be more reluctant to take the cash out of their primary residence because they've never seen the extreme benefits of owning real estate over the long haul. You get that tax advantage, you get the appreciation, you get the cash flow. So we're seeing a lot of people with the portfolio, same thing. They're the ones who are a little bit more aggressive. And I hope that knowledge and confidence will trickle down into other categories so the newer people can also take advantage of the market, just like the senior people who've been in it for a lot longer.
Absolutely.
Yeah, to be clear, if you have rental properties, you can take it out as well. Like, you don't have to have, it doesn't have to be just your primary residence. A lot of people who have rental properties, there's tons of equity in everything right now. So, and if maybe you don't qualify for a conventional loan, the rental properties are great DSCR loans, pull cash out all day long.
Yep.
I like the color. I just noticed
Yep.
It's the Astro orange and blue for Houston.
And a little Astros rocket in the right-hand corner. Well done.
Nice.
So here in Houston, going through the numbers, single home sales fell 17%. That's really not a surprise. And the new home sales at this moment are still way higher than they were all the times previous to the COVID levels, which were just incredibly high. But there is going to be a reduction. We're also going to have the seasonality here. You see the total property sales were down 17%. Total dollar volume was off 8.5%. So still, with the home price increases, the units are more off than the volume, right? And as you go through this category, another thing that you see is the total active listings is up significantly. That's not a surprise, right? The market was so hot last year, things are just flying off the shelf, and we're going to start to see a more normalized market on months of inventory. That's a very important indicator, right? Most people will say a balanced market is 6 months of inventory. We're still at 2.7, very historically low, but nowhere near the 1.7, which is just off the charts high where we were at last year. And then the pending sales also down. So that's going to kind of trickle into the total property sales, but there's not as many pending sales at the moment. So I think we're going to continue to see lower sales overall, fewer retail buyers because of rates. But I mean, we're seeing a lot more investor transactions. We, fortunate to break records 3 out of the last 4 months. That's definitely not what's happening in the retail space, but it's definitely happening in the investor space. So these numbers are going to continue to trickle down, in my opinion, but you're going to see investors' numbers continue to trickle up, which is not going to be seen here because they're such a smaller percentage of the overall transactions.
Yeah, the 1 month is that's a significant number, going from 1.7 to 2.7. That tells me things are normalizing a little bit, but the prices are staying strong. they're still really strong, right?
Mm-hmm.
A little over $400,000.
I think that's the crazy number to see. I mean, obviously, with the raising cost of construction to build a new home, it's costing every bit of $150 to $200 a foot. So there's some merit in buying these homes, these older homes, where you're doing a ton of rehab and kind of capitalizing on that equity, because just with supply chain demand issues that they're having and construction costs being so high, this is the way to go. And those numbers are crazy to see, but I definitely think buying these older homes and doing rehabs and leasing them out is the best way to go.
For sure. And to Jeff's point, still 11.6% appreciation. Historical numbers are somewhere around 7. That's still a really strong number. I think that's going to continue to trickle down. We've been saying that for a while. I don't know that Houston, Dallas, and San Antonio are going to see like home price depreciation at a significant level, but I think we're going to see deceleration in what was kind of highly unusual for the past couple of years. 18% is just a really big number that's not sustainable over time.
Yeah. If and when those numbers get down to 0, then that's a significant event. But I don't see that happening anytime soon. That 11% number.
Yeah, I mean it could certainly could. I think the migration patterns, which we're not talking about today a ton today in this presentation, but we covered a lot in the past. Tons of people moving from higher tax states without the robust economy of Texas. We also do a lot of transactions in some other areas that are in the Sun Belt. Those areas all seem really strong because there's so many people moving into those areas because of the economy, low tax rates, other things. So I think as long as that continues to be a big trend, that can overcome some of the interest rate challenges and recession challenges that are out there.
Yeah, there was we didn't use the article, but there was an article talking about like hot markets or whatever for next year, and one of them was in Johnson City, Tennessee. But they graphed where people were looking for real estate in that area, and 2/3 of them were from out of state. Like 2/3 of those people that were trying to move to, if you're looking for a house in Johnson City, Tennessee, 2/3 of the people that did it were from New York, New Jersey,
California.
Yeah, I don't know if there was maybe a little bit of California. They probably aren't moving this far east. They probably were moving into parts of Texas, right? Or Arizona. But they were elsewhere in this example for sure. There's very few people that are just like moving within the city.
Yep.
But California, yeah, it's the same problem. Just they're going. I don't think they're moving this far east. They're probably picking Austin, San Antonio, places, Arizona, etc. Okay, so speaking of the devil, San Antonio. So very similar market to Houston. The actual number of sales, 3,100 versus 3,600 last year. So it's a 13% decline. The average price is $389. So Houston is $414, so it's a little bit cheaper still. The average price last year was, call it $350, which is a 12% gain. Exact same gain Houston had. Houston was 11.6, San Antonio is 12. So it's very similar markets. Median price $337. That's a 14% jump. Houston was a 15% jump. So like you can tell, these markets are very similar. Days on market is 42. Last year it was 28. So, and I think if you go back to Houston day on market was 37. So they're very comparable markets. The rents are still strong, right? The average price is $1,828. Last year was $1,700. So rents are still going up quite a bit. That's $100. That's kind of what I'm talking about. If you bought a property last year and you were only cash flowing $100, now you're re-up. If you do nothing else, that's an extra $100 in your pocket when you re-sign a new lease. So rents are going up about, like I said, about $100 a month. So very, very, very strong rental market. I don't know if you guys are doing a lot of stuff in San Antonio, but we see a lot of deals come across our desk that are in San Antonio. You can get those good deals too, low out of pocket. It's just a good time to be an investor in San Antonio right now.
You guys do quite a bit there in San Antonio as well, Haitham?
There's a few portfolios out in San Antonio. I don't see many transactions in San Antonio, more so Austin and Dallas.
Interesting.
But San Antonio, not so much. I mean, obviously there's some one-offs with certain clients, but the majority of it's Houston, Austin, and Dallas.
We'll have to exchange, you know, some good clients, because I think we're seeing a lot more in San Antonio at the moment than we are in Dallas and Austin. That's a very interesting thing. We think that San Antonio market is very comparably, a lot of the demographics and price structure is very similar to Houston, really high cash flows. You know, Austin, for a lot of single family investors, tough area to get into, but I know you guys do a lot more of the commercial multifamily things, and that there's a lot of activity going on in Austin and Dallas for sure there.
Is this more inside like Hill Country area, or?
No, I mean, true San Antonio is where we're seeing a lot of the activity. Yeah, for sure.
Nice. And the rates are significantly lower out in San Antonio as opposed to Houston and Dallas. So insurance rates are good out there.
Oh, really? Interesting.
Yeah.
I guess fewer disasters, right?
Mm-hmm.
Yeah. Okay, let's cover Austin. And this is really interesting information. I'm going to hop down to the months of inventory, and I don't remember the exact low. We've been doing this webinar for quite some time, but I seem to remember months of inventory getting as low as like 0.5, which was just unheard of.
I was going to say 0.3 was my guess, but yeah, it was really low.
So, and it's interesting that the months of inventory in Austin is greater than Houston now, which we have not seen in some time. I think that market just got incredibly hot. Median sales price still up 5%, much lower in closed sales, you know, pending sales, active listings up 162%, big numbers. So I think that market is definitely starting to balance out. I think if I were going to pick one market in Texas that had the biggest opportunity to potentially decrease, I would say that is an area that has an opportunity, because it was so hot that there is a chance for that pendulum to have gone too far, and then for maybe that to normalize a little bit. I see a lot less probability of that in the areas that did not go up as much, because you know, I think Houston's peak was maybe 18%, San Antonio was maybe 17%, Dallas may have gotten up to 21% appreciation, but I think there were points when Austin was high 30s. So it's just a totally different scenario. So there is some real chance for corrections there, but that's not an area where a lot of buy and hold investors were. Flippers, a lot of flippers in that market, and there could be some challenging times ahead for those individuals if they were kind of betting on the come that there was going to be a lot of ongoing home price appreciation. And that sometimes happens with flippers. They're buying today for what they think prices are going to be in the future, counting on that rapid appreciation. Some of those people may be caught in a difficult spot. The more savvy investors are really looking at where things are instead of where they could be. And I think that those Austin area investors are going to do just fine, because they're still a very desirable area, a lot of jobs, a lot of things going on. I think there's just going to be a little bit of a correction from one of the hottest markets we've seen in Texas and probably ever. You know, it was just crazy what was going on in Austin for a while there.
Yeah, if you look at the just the price, right? That's their plus 5% medium sales price. San Antonio was what? It was plus 14. Houston was plus 14 or 15. So it is significantly lower on the price appreciation already. And the months of inventory, who would have thunk it? You know, a year ago, the 3.1. There's more months of inventory in Austin than there are in Houston. Houston's below Austin, which is unique. All right, next slide, please. There we go. So Dallas is a little more akin to the other two markets. Prices are still up 11%. Active listings are up significantly. Closed sales are down significantly, about like the other two markets. They bake in like mortgage processing times on their days on market, so you got to kind of eliminate that to get a comparison. So 32 days on market, you know, very similar to the other markets. I think San Antonio is 42. The months of inventory 2.4, so they are at a lower months of inventory than Houston, higher than Austin. We've been seeing a lot of deals in the Dallas area, not so much Dallas proper, but more so like the northern territories up in there in Dallas. A lot more economically priced homes. You can cash flow well up there. Basically from Dallas up to Oklahoma. There's a lot of communities up there where we're seeing a lot of deals. So it's still a good market for buy and hold investors up there. You just got to find the right spots.
So you said Dallas was the first place you've mentioned. So tell us a little bit about what you guys are hearing on the street for Dallas.
I actually just spoke with a couple of my Dallas investors, and they said that there's just a lot more on the market than there has been in the last few years, which has, and I have two different types of clients. I got home builder clients, and I got some buy and hold guys, and obviously there's just a lot more competition on the market, which caused them to drop their prices on when they're selling properties. So things have changed a little bit, and they've mellowed off, but they still see it as a great market to be in and looking to buy as much as possible. Even for the home builder guys, are looking to buy as much land as possible and start building. And these guys are in the the $500,000 to $700,000 home threshold. Just still a great market altogether.
Yeah.
Next slide.
Very good. David has relayed to me that there's a little bit of a delay. He is responding quickly. The interwebs are responding more slowly. So,
House is getting tired.
Yeah. So this is a great chart. But I'm going to go over what we have here. The one chart, the brown green line there is total population, all ages, right? The other is housing starts. So you can see this chart and a steady uptick up through the great financial crisis, right, 2007. But the population back then was 300,000. And look at we have never gotten back the entire time since the great financial crisis, anywhere close to the number of homes that we were building back then. And there's another chart we don't have today, which goes all the way back to the 60s. And there's not been a decade going back to the 60s when fewer homes were built than the last decade. So despite the fact that interest rates are going up, the population's going up. As Jeff mentioned earlier, millennials are at prime home buying ages, and there's still a dearth of properties. And new construction permits on single family are down pretty significantly.
Yeah.
Apartment permit requests are still riding high, and I think that's because people know with higher rates, people are going to have to rent. So this is why it's a really exciting market for single family, multifamily investors in the residential space, because these people are going to have to live somewhere. And with higher rates, they're going to be more apprehensive to buy a primary residence at this time, right? So these numbers here and the migration into the Sun Belt are reasons why we still feel like there's still going to be that opposite effect from interest rates. Interest rates are going to impact home values without question, but the supply and demand, I think, is going to be the biggest driver, and that supply is going to be down for the foreseeable future, especially because the reduction in new home permits. That means we're still not going to catch up to where we needed to be previously.
I don't know if you guys feel this way or not, but like, I felt like there was a little bit of momentum that homes were being built at a rapid pace, and then these high interest rates just killed that immediately, because you can't, like you said, Haitham, prices are so high to build. It's a minimum threshold to just build a property, and then when you take that number plus rates making payments so much higher, incomes just aren't keeping up yet. So like there weren't enough buyers for these properties. They're going to be priced to where the payments are just too high for people to afford it.
I agree. Even these massive home builders, I have a realtor buddy of mine. Well, all he does is sell large land for new developers, and he had large deals just fall off the table because of interest rates today. Obviously, those opportunities will come back around, but like you said, it's not going down anytime soon. So time is now.
Yep.
So this is our last chart. I'll go through it real quick and see if we have any time for questions. A few minutes left. It's an affordability index, and so it kind of points to what we were discussing earlier about how, if you're a real estate investor, there are still plenty of opportunities in Texas, because there's only one city in the top 20, Austin. This is basically a measure of the average income versus the average mortgage payment in a city. And so you have Miami, LA, New York, Newark, and Hialeah, Florida, which are all just ridiculously expensive relative to the income. And then we just kind of highlighted some of the major cities. So you see Austin at 20, Phoenix at 25, then you got Dallas and Houston. San Antonio is all the way down there to 56. So that's kind of what I was talking about. Like there's still a lot of good opportunities to find properties in San Antonio.
That's attractive.
That's a big market, and to be all the way down to 56, that just tells you there's a lot of room for improvement there.
And Jeff, correct me if I'm wrong. My recollection is that San Antonio got up to around 26, and Houston was as high as 20. Isn't that right?
Yeah, I don't remember exactly what they were, but I just remember they were a lot closer. I'm pretty confident there was a point in time where Houston, Dallas, and San Antonio were way more compact on this list than they are right now.
For the next presentation, Derek, if you're listening in, let's bring back those highs. Jeff and I may have to make a lunch wager. I tend to think that Houston was up around that 20 point at some point.
Right.
I could be wrong, but I know it was significantly higher. And I think Jeff and I are in agreement that whenever you look at the affordability relative to other points of the country, and we definitely need to show the context next time, it's much more affordable across Texas. Austin's still hanging on there, but Austin got a little higher too. But I know that Dallas, Houston, and San Antonio are significantly better relative to the rest of the country than even just 6, 7, 8 months ago on this chart.
Yeah, for sure.
So I know it's time to move into the question section. I'm not sure. I know Derek was experiencing some technical difficulties, so I may just go. Oh, there he is. Super.
Hey there. I'll see if it works now. Internet's going in and out. Apologies.
Well, you guys sent me the questions, so if you want me to cover them, Derek, I'm happy to. If you're having some challenges there, that's entirely up to you.
Yes, you feel free to go through.
Okay, yeah, because I can see the questions that we have here. So I'm going to ask the first one. There was a question that came in for Haitham regarding, what are some innovative insurance products that maybe people want to know about in the current environment? Do you guys have anything new coming out, or anything for the buy and hold investors to better navigate the current conditions?
Just the REO program. I think that is the best way to encompass all your policies, including flood insurance. That's, as a growing investor, you don't want 4 or 5 or 10 different renewal dates. You want to deal with your insurance agent one time a year, just for the sake of time. Your time is money. Focus on deals, not so much on insurance. I definitely think that's the best thing on the market.
That's great. Yeah. And then another question that came in was, there's a question about a lot of noise out there regarding groups with lots of capital buying homes from new home builders right now. New home builders are looking to get out of the market some. I don't know, Jeff, if you've heard about that or Haitham, but evidently there's people buying groups from both small builders, more custom home builders and smaller groups, or even from some of the more major players. Like I think I saw something the other day. It was like I hate to say it and then say it incorrectly, but a relatively large builder that had also sold some to like a hedge fund or a private equity fund. So we are starting to see this. Like there's home builders wanting to take some chips off the table, selling at a little bit of a discount in order to do it. But real estate investors, once again, being unafraid because they have a lot of confidence in the strength of rents going forward, right? Have you heard anything about that, Haitham or Jeff?
I have a little bit. Definitely some venture capitalists buying in on some land deals. Are you speaking more so of like the major home builders selling out?
I don't know. I did hear one that was of reasonable size. Yes, I listened to a Wall Street Journal podcast the other day that was talking about that. I can't remember the name of the company. It wasn't one of the like top 10 players, I don't think, but yeah, there are definitely some bulk sales, and I think it's a little bit more prevalent in the smaller home builder market, right, where we're seeing that as well.
I have not heard anything lately. I know there, a little while ago it was hot and heavy, and these firms were just buying entire neighborhoods and stuff like that. But I haven't heard anything lately. It doesn't mean it's not happening. I just can't think of anything anecdotally.
Yeah, I have heard some about that, and I think I think, what is that a concern? Well, there's two sides of that coin, right? One side is a home builder trying to find retail buyers. Right. They sound like they're a little bit more nervous, and that's somewhat logical. I think flippers need to buy very intelligently right now because you have to have an end buyer. Conversely, the other side of that coin is that there are very smart people. The hedge fund and private equity guys are usually really smart people, and they are willing to buy these properties. And that tells you that they have a high level of confidence. So, you know, you can always, anytime there's a transaction, there are two sides to a transaction. So what should we as real estate investors glean from that? I think it is be cautious in the flip space. Not that you can't do it, but you need to be very cautious. Don't expect massive home price appreciation whenever you're making your purchase, right? And then the other one is do what the really smart people with a lot of money are doing. Try to buy more properties. They're doing it in bulk from these builders, and you can do it in a different way. And I think the best way to do that, we've always seen, is the value play, where you buy that distressed property. You don't have to do new construction. To Haitham's point, you're not paying $200 a square foot to build, which is probably going to be the number if you're not doing it in bulk, right? If you're just a onesie twosie person, it's going to be higher, inevitably. And then, but you can still buy into these discounted homes in areas like Houston and San Antonio, or maybe even the more tertiary markets, and really get good prices and get great cash flow. Yeah.
I agree.
I have one comment that came up. Let me just make sure. I thought I saw something come up from David. Just make sure we're wrapping up. There was a question that came through. Somebody mentioned that you mentioned lower insurance in San Antonio when people are making a valuation. Do you have a rough number of the delta between Houston and San Antonio, or Dallas and San Antonio?
Yes, it's about 25. So the rates out there are about 50 cents, 50 to 55 cents per $100 in coverage. So, you know, $1 million in total coverage is about $5,000 versus here, which is about 7 to 8. So yeah, I mean, there's a pretty considerable difference between there. Austin is pretty low as well. You know, they're just not susceptible to many disasters out there. They have hailstorms from time to time, but for the most part, we get the brunt of it, being where we're located. And Dallas just gets a ton of hail, just random hailstorms, and people file and get new roofs all the time. I mean, they're losing millions in Dallas every year.
Yeah.
Wow.
So they say.
Sounds like, if you're doing math, it sounds like maybe a 15% discount to Houston. So
Roughly.
That's significant. I'll tell you, whenever you're working your numbers, that's something to definitely keep in mind. Well, I think it's about time to wrap up, everybody. Really appreciate everybody who joined. And you know, if you aren't able to attend regularly, to Derek's point earlier, you and your friends, you know, spread the word. We hope we're providing some good information. We try to bring in really good guests. So you and your friends can sign up to get this emailed to them as well. Derek does a really good job of distributing that. But I want to thank Haitham again for coming on the call today and providing some great info. And if anybody has any interest whatsoever, I think you should always run a quote past this group, even if you have somebody that you like working with. And their information is here. If anybody needs it, please reach out to our group if you need it outside of this, although they've got their phone number, email address, and all that other stuff. So you should be able to reach out to them pretty easily. But once again, Haitham, thank you very much. Everybody have a great day.
Guys, I appreciate you guys having me on, and there's no better guys in the business than Jeff and Wade that do it like they do. Just willing to educate people on a monthly basis. You guys are awesome. Y'all helped a ton of my clients, and I appreciate you guys.
Thanks, buddy. You have
thanks for hopping on. All right. See you guys.